Pfizer, ticker PFE, is down by 13.90% over the past month, and year to date they are down by 16.20%. Now, if we have a look at the 5-year chart, we can see that over the past 5 years they are actually down by 31.38%. After announcing their COVID-19 vaccine, they went up in price enormously, reaching an all-time high of $59.48 in 2022. But since then, they have been tumbling down in price and are currently sitting at only $24.92. So today, I want to figure out whether a company is currently over or undervalued, and whether it might be a good idea to buy the company right now at its current trading price for a great return. And to do that, we will jump to our stock valuation spreadsheets, where we will have a look at the 9-pillar analysis and evaluate the 9 most important metrics every investor should consider before buying a company. And after that, we will also find Pfizer's intrinsic value using the Graham's formula revised, discounted cash flow model, multiples valuation model, and the dividend discount model. So first of all, we will plug in PFE, Pfizer's ticker, and wait for all the metrics to show up. Now right away we can see that Pfizer is a dividend company, and they actually have a very high dividend yield of 6.75%, which is much higher than the average dividend yield in the S&P 500, and is even more impressive for a company which operates in the healthcare sector and has to pump a lot of their free cash flow into innovation. Now this dividend yield gives us a dividend payout of $1.68 and a trailing free cash flow payout ratio of above 50%, 55.30%. Now, as I said, as Pfizer is in the healthcare sector, they have to pipe a lot of their free cash flow into innovation. So a trailing free cash flow payout ratio of above 50% is getting a little dangerous, and means that they have only about 45% left over to buy back shares, pay off debt, and invest back into the business while increasing their current dividend. So let's check out the 9-pillar analysis and see how they are doing. We can see that they have a rating 6 out of 9, with 3 pillars out of the 9 currently sitting in the red. And the first pillar is the 5-year PE ratio to be below 22.5. We can see that for Pfizer this is currently sitting at 29.63, which means that investors are currently paying $29.63 for a dollar of Pfizer's earnings, which is quite higher than what investors pay for other companies' earnings, and tells us that Pfizer would be considered overvalued compared to their earnings. But if we have a closer look at the 5-year PE ratio, we can see that from 2019 they have actually been decreasing their PE ratio to about 8.44 in 2021, and only in 2022 did their PE ratio jump up tremendously, but since then they have actually decreased it back to 33, and currently it is sitting at 33.72. So this tells us that they are actually pushing their PE ratio down, and if they continue to do so, their PE ratio might be closer to the value we want to see in the next few years. Now the second pillar we want to have a look at is the price to free cash flow, which is actually very similar to the first pillar, but instead of earnings we have a look at the free cash flow, and we want this to be sitting below 21. For Pfizer this is sitting at 21.06. It is currently highlighted as red, but it's close enough to 21 and tells us that Pfizer is fairly valued compared to their price to free cash flow. And looking at the final pillar in the red, the decreasing shares outstanding. Now normally we want the company to be buying back shares of the market, as it increases the value of the shares we own of that company, as there are less shares outstanding. And Pfizer has actually been increasing their shares outstanding by 0.35% every single year over the past 5 years, which is a very small number and doesn't bother me that much at all. And now let's move from the negatives of Pfizer to the positives. We can see that their revenue growth is growing at a rate of 16.04% every single year over the past 5 years. Their free cash flow has also been increasing by 16.59% yearly over the past 5 years on average, and their net income has been increasing by almost 30% yearly over the past 5 years. So Pfizer is showing off some great growth, and if we have a look a little closer, we can see that indeed their revenue grew from 40 billion to about 100 billion in 2022, and then in 2023 it decreased to $58 billion. Similarly, with the net income, in 2019 it grew from 16 billion to 31 billion in 2022, and in 2023 it decreased to 2 billion. So they are growing at very nice rates, but 2023 just wasn't a great year for them. Now moving back to the 9-pillar analysis, for the next pillar, we want the 5-year profit margin to be above 10%. For Pfizer, it is currently sitting at almost 70%, so that is great. Now with every dividend company, we want there to be consecutive dividend growth. And for Pfizer, this is currently sitting at 1.83% every single year. And the reason why we want there to be consecutive dividend growth, and I can give an example. So when Warren Buffett bought Coca-Cola in 1983, Coca-Cola had consecutive dividend growth. So currently in 2024, for every dollar he invested back in 1983, it yields him 50%. So for every dollar, he gets 50 cents a year, which is an extremely high dividend yield and is one of the reasons why he's such a successful investor. So we can see that Pfizer has a consecutive dividend yield of 1.83%, so that is great. And finally, we want to have a look at the 9th pillar, which is the long-term liabilities over the 5-year free cash flow negative dividends to be sitting below 5. And this is probably the most important pillar out of them all. And it tells us whether a company generates enough free cash flow to pay off all their long-term liabilities while paying out their dividends so that they don't get into trouble with debt and in the worst case, they don't go bankrupt. So we can see that even though Pfizer has been increasing their long-term liabilities at a rate of 8.13% every single year, their free cash flow has been growing at a rate of 16.59%. So they still have much more free cash flow to pay off all their long-term liabilities. So the ratio is currently sitting at 2 for them, which means that they can pay off all their long-term liabilities in about 10 years, still giving them a lot of free cash flow to increase dividends, pay off debt, while buying back shares and investing back into the business. And now let's finally calculate Pfizer's intrinsic value. So first we will jump to the Graham's formula revised. And here we will take the 5-year earnings per share sitting at 2.86, the base PE, the 5-year growth estimate, the growth rate multiplier, the average yield on AAA corporation bonds, and the current yield on AAA corporation bonds, and get an intrinsic value of $28.79, which is 14% higher than the current trading price of Pfizer. Now moving to our next valuation model, the discounted cash flow model. And here we take the free cash flow over the past 5 years and calculate the average growth rate to be sitting at 16.59%. Now based on my research, I don't really think that they will grow by that much over the next few years, so I will calculate a growth rate of 5.2% and plug that in. Now using this growth rate, I calculate the future free cash flow including the terminal value. Now to calculate the present value of that future free cash flow, that is the future free cash flow accounting for inflation, we have to plug in a discount rate. And the discount rate is essentially the return you want from the company. So when I plug in a discount rate of 5%, I hope that Pfizer will return at least 5% yearly. And using this, I will calculate the present value of that future free cash flow. Now I will sum all of that up, add any cash and cash equivalents, and subtract total debt. And I will get an equity value, which I will divide by the shares outstanding and get an intrinsic value of $28.57, which is again quite higher than the current trading price. Now moving to the third valuation model where we compare Pfizer to its competitors, so AstraZeneca and SNY. We will take these companies' current stock prices and divide by their earnings per share to get their PE ratios. We will then average out these PE ratios and multiply by the earnings per share of Pfizer to get an intrinsic value of $20.64. Now their current EPS is sitting quite lower than the average earnings per share over the past 5 years. So if we have a look back at pillar number 1 and scroll down, we can see the earnings per share over the past 5 years. It has been moving at around 2, and only in 2023 and 2024 did it fall below 1. So I think it is quite fair that we plug in 1 instead of 0.74. So if I do that, we get an intrinsic value of $27.90, which is again about $3 higher than the current trading price. And finally, moving to the dividend discount model, we take the dividend payouts over the past 5 years and calculate the average growth rate to be sitting at 3.31%. Now we can see that over the past 3 years, they have been increasing their dividends by about 2.5% every single year. So I will project a growth rate of 2.5% into the future. And when I plug that in, we get an intrinsic value of $67.24. And this very high intrinsic value was quite expected as Pfizer does have a very high dividend yield. And now let's move to the ultimate valuation. We will average out the 4 models we did. We will switch from the alternative dividend discount model to the dividend discount valuation and get an intrinsic value of $38.12, which is 53% higher than the current trading price. Now, as the dividend discount model is an outlier, if I was to remove it, we would get an intrinsic value of $28.42, which is still higher than the current trading price by about $4 or 14.18%. And so if I plug in a margin of safety of 10%, I would still get an acceptable buy price at $25.58, which is about $1 higher than the current trading price. And so after this valuation, we can see that Pfizer is currently trading quite close to their intrinsic value. It is also quite clear that as a business they are doing very well and they are set to grow in price over the next few years. And with that, I hope that you enjoyed the video. Make sure to leave a like and subscribe as it really helps me out.